Welcome to Money channel. In this video, I'm going to show you how to take the headache out of break-even analysis and make it straightforward. Are you struggling to figure out your break-even point? Many people find this process confusing, but I'm going to walk you through it step by step so that you can understand it easily. Stay tuned. What is a break-even analysis? Break-even analysis calculates how many sales it takes to pay for the cost of doing business. This includes both the revenue and associated costs. The break-even analysis tells you how many sales you need to make to cover your fixed costs. A demand-side analysis can help you figure out how much people are willing to pay for your product or service. Key takeaways: break-even analysis can help you figure out how many products you need to sell in order to cover the costs of making those products. This includes both fixed costs and variable costs. The break-even point is a measure of how much profit your business needs to make in order to cover all its costs. Break-even analysis is a financial tool that is used in many ways. It can be used for things like stock trading, options, as well as for budgeting for different projects in businesses. How break-even analysis work? Break-even analysis is a study that helps a company figure out how much they need to produce or sell in order to make no money or even break even. This information is for the company's own use, and is not shared with people outside of the company, like investors, regulators, or financial institutions. This type of analysis calculates the break-even point. The break-even point is found by dividing the total fixed costs of production by the price per individual unit minus the variable costs of production. Fixed costs are those that remain the same no matter how many units are sold. Break-even analysis looks at how much money a company makes from each additional unit it produces and sells. Companies with lower fixed costs will have a lower break-even point of sale. For example, a company that doesn't have any fixed costs will break even when it sells its first product, assuming the variable costs don't exceed the sales revenue. AAPL, Apple Incorporated, NKE, Nike Incorporated, AMZN, Amazon.com, Inc. WMTA, Walmart Incorporated, select investment amount. Select a purchase date, 2 years ago, 5 years ago, 10 years ago, calculate, special considerations. Investors are not usually interested in how much money a company makes in order to break even. However, investors may use this calculation to determine how much they need to make on a trade or investment in order to break even. This calculation is especially useful when trading options or securities products. Contribution margin, break-even analysis is used to figure out how much money a product makes. The difference between the price of the product and the cost of making the product is called the contribution margin. If an item sells for $100, then the total fixed costs are $25 per unit. The total variable costs are $60 per unit, and the contribution margin of the product is $40. This means that for every item that is sold, the company makes a profit of $40 after covering all the variable costs. Calculations for break-even analysis. There are two equations that can be used for break-even analysis. The first equation calculates the unit contribution margin by dividing the total fixed costs by the number of units. In the example above, if the value of the entire fixed costs is $20,000, then this equation would find the break-even point. The break-even point is 500 units. This means that if the company sells 500 units, it will have covered all of its fixed costs and will not have any profit or loss. You can calculate the break-even point in sales dollars by dividing the total fixed costs by the contribution margin ratio. The contribution margin ratio is the contribution margin per unit divided by the sale price. The contribution margin ratio for this business is 40%. This means that the break-even point in sales dollars is $50,000. This can be confirmed by multiplying the break-even in units, 500, by the sale price, $100, which equals $50,000. As always, thank you for watching. And feel free to leave